Welcome, everyone, to episode 2 of the podcast. I have Dave from Wealth Adventures. Is that right? Is that the right YouTube channel, Wealth Adventures?
That is correct.
Okay, perfect. So I have Dave here with me. We're just going to jump right in. It's Dave and Dave's podcast today because my name's technically Dave as well. So this will be fun. So, Dave, I just wanted to jump right in and ask, what is your investing story?
Yes. First of all, thank you for having me. I love that you reached out. I love that you're trying something new like this with your channel. So, as far as my investment history, I'm 52 years old, so I've been around a while, and I go back when I think about my first investments that I made way back in the day. It was right after I got out of college, and I would say I was not a great student. I came out, I didn't have great grades. I had a useful degree. It was in chemical engineering. So I was able to jump in and get an okay job. But I definitely felt that, inadequacy. I didn't feel adequate going to work. That is, like, I felt like I was going to fail miserably and they were going to send me packing. So I think right from the get-go, I had this idea in my head that I better start saving right away. And I didn't know anything about investing other than my dad taught me a little bit about it. He would show me stock certificates that don't even exist anymore. Now that everything's electronic, but back then you actually used to receive stock certificates, or you could way back in the day. So I learned a little bit about the stock market when I got out of school, and I definitely started saving. I opened up a Fidelity account at a very early age, thanks to my brother, who also kind of gave me some guidance, and I started investing mainly in individual stocks that I did not know much about, but I also bought some mutual funds at the time and kind of got started that way. But I was living well below my means at that point. I was driving an old Mazda. I had rent that was about $250 a month. And so I was able to save a lot early on and start to build up a little bit of savings and investing. And before I knew it, I met my wife. We got an apartment together. Then we bought a house with the first savings that we had. We took that out. And this was all in the late 90s. So we were headed towards the .com bust.
Can I ask how much you paid for your house back in the day?
We paid $150,000 for the house. We put down $7,500 and our interest rate was 7.5%. And I remember thinking that was perfectly fine. I know that's very different than it is today, but back during that era, that was kind of the going rate for a long period of time. Before and after was right around that 7%, 7 to 8%. So it wasn't out of the question. Now, we've just had low rates for so long that people got very accustomed to these low rates. So when we spiked back up to around the 7.5%, people were shocked by the sticker shock. But we didn't think much about it. And if you put debt in front of me, I'm definitely not Dave Ramsey, like it's evil or bad, but I will attack that debt. So it's almost easier for me to attack that side of the equation than the stock side of the equation. So I was taking money and I was just pouring it into that house. We paid that house off in 5 years.
Wow.
So in between the two of us, we both had decent jobs, but it was really just like, let's kill this debt off. And that's what we did. So during that period of time, we were also in 401ks and things like that, and slowly started building up our investments. But the .com bust truly changed things because it kind of taught me the first lesson, which was things that go up can come down really quickly. I know I don't have any records that I can pull up from, but that was definitely the first time that I really got burned in the stock market because I sold a lot of investments. I remember taking that money and like, I'm just going to put more on the house. That's safe. I know about that. So I definitely played that very poorly because I should have been continuing to buy in the stock market at those low prices. But without a lot of experience, when you're young, that's sometimes the best lesson you can have when you don't have a lot of money to do that with. So that was kind of my early investing career.
And you don't have much of or do you have a finance background, or is this something you kind of just picked up along the way? I know you said you worked in business and you've managed teams and you've started other businesses, but when did you kind of start getting more into like the finance side of it?
When I got out of school, I opened that Fidelity account. I started learning. I started reading investment books and things like that. So despite not being that bright, having poor grades, I was a very avid reader. And I started to understand the financial markets a little bit. And then throughout my career, running a business, owning real estate, and doing just having a very well-rounded background. I would say I'm kind of jack of all trades when it comes to different investment vehicles. I learned along the way. So a lot of it was trial and error. Like I've been trading options for 10, 12 years probably now. And just kind of that learning curve and getting through that, learning how to do these types of things over those years kind of paid off. So it just gave me a very well-rounded background, and I tried a lot of things. And I've always been a big proponent of being as diverse as possible. So if you were to really break me down, you'd see I've got kind of stuff scattered everywhere. I'd be hard to get to, completely destroy me. Be hard to get.
Yeah, I guess you could never really be. I mean, you can be too diverse, but like, there's nothing that wrong with being too diverse either, right? But if you could go back to the beginning, like maybe, I guess if you've learned any lessons, right? What's something that you maybe would have done differently, and what's kind of a lesson that you've learned that would be good kind of advice to someone who's a little bit younger?
Yeah, if I could go back and do it over, I would teach myself that these boom and bust cycles are good for me, especially when I'm very young. So a recession, while not great for people out there, we're going to lose jobs, all these other problems that come along with that. From an investor standpoint, if we have a market crash from that recession, well, then that's a great time to be buying. This is when you want to pour money into the stock market, right? We want to buy at those low prices. So that's what I would learn. I would learn that sooner. So the first time that it really came around for me would have been the dot-com bust. But then after that, we had the great financial crisis. We had COVID, things like that. I was more prepared for those periods of time. So COVID had caught everybody off guard, except for a couple hedge funds, right? Yeah. But like the great financial crisis, when that happened, I didn't take money out of the market. I adjusted some of my positions, but I was smart enough at that point, and I'd been through it, that I would just continue to buy. So when you're young, the best thing that can happen is that the stock market goes down. It's very unintuitive, but if you're a growth investor and you've got 30 years, which you should be a growth investor at that point, you should be buying these products that go on sale. And you shouldn't be rooting for the downfall of the market, but it definitely can help you in the long run when some of that comes out of the market.
Yeah, I think when I was very first starting out, that was probably one of the hardest things to do, because when you see, I just have a Robinhood account as of right now, and it's the same one I've had for years. But it's funny because when the market falls, the very first thought you have is, oh, I need to get everything out. I need to sell. So one big lesson that I've had to learn is that you have to really just switch your mindset. It's almost like a 180 to, instead of saying, oh, I need to hurry and sell because it's just going to keep going lower. Rather than that, thinking, this is a perfect time to buy. Things are getting cheap. They're going to be much higher in 5 years from now or 10 years from now. So now is a really good time to buy. And yeah, like you said, you don't want to wish for the downfall of the economy. You don't really want a recession, but it is good when stocks get cheaper so that you can kind of load up and increase your positions, and of course not sell, because that's probably one of the worst things you can do when stocks are falling, right? So at this point, you're more of like a seasoned investor, right? Are you at this point more focused on dividend income, or are you still focused on dividend plus growth?
I would say I'm more growth, but I have lots of dividend focused products. So I do own SCHD. That's one that we've all talked about on YouTube, right? It's very popular. But if you look at my portfolio, I still have a lot of growth stocks and a lot of growth ETFs that do not pay out a lot of income. They're very tax efficient in a taxable account. And that allows me to decide when I'm going to take that off the table. So I'm still in my peak earning years. I make a lot of money. So it doesn't make a lot of sense for me to be in a lot of products that pay me more money, that allows me to pay tax before I receive that income. So I review and talk a lot about income products because that's kind of my audience. A lot of people are at retirement or in retirement, so they're very interested in that kind of product. But for me, it doesn't make a lot of sense. So that account that I set up where I own the covered call ETFs and things like that, pretty small in comparison to what I have as far as my growth products. So I I think we talked a little bit about it, but I think depending on where you are financially, if you can afford to be in growth, even in your 50s and 60s, you should continue to do that because total return is what is going to give you the most money. Whereas any covered call strategy or sold calls, sold puts, typically are going to cap your upside. And we know we have those big swing days, right? We have those days where the stock market just takes off. And if we cap that upside, we're going to lose out. So there's a cost of that insurance, and that cost when you buy those products can be pretty steep. So I continue to be primarily a growth investor, slowly adding to some other positions.
Yeah, that's an interesting point because I feel like a lot of people, even younger people like myself, they get very caught up in the huge dividend paychecks, right? We now see the extremely high yield ETFs that are yielding 70, 80, 100%. And people get really excited about those because all they think about is that dividend paycheck every month, or now we have some that pay every week. And even for myself, it's hard to not just want to go all in and get those big paychecks without realizing that your total return at the end of the year is 5% or 10%, sometimes in the negative, just because of how much they decay. And yeah, it's hard to kind of only focus on the total return when we have those products that are paying so much in dividends. Because I think everyone's dream is to retire really, really young. And those can kind of, I don't know, blur our vision a little bit. And some people make it work. Some people can, trade options to offset or whatever they might do to make it work. But I think for the average investor, I don't think chasing yield is a great idea. But focusing on total return, right? Kind of like what you were saying. Some people might disagree. Some people really like the whole dividend investing movement. But I think there's different ways to do it. And like you said, focusing on total return and getting that high growth is a lot more efficient.
Real quick, yeah. If you don't need the income right now and you're a young person, then don't take the income, take the growth. It doesn't make any sense to be taking income when you don't need it. But I know it's like, I want that payment and they want that immediate gratification. It's definitely a driving factor. Right?
Yeah. Yeah. And I totally get it, right? Like it'd be awesome to not have to work a normal 9 to 5 job. But there's just no free lunch at the end of the day, right? You have to have a big enough portfolio to be able to make it sustainable, right? Like some people think that they can put in, $5,000 or $10,000 and then, make $2,000 a month.
No.
Yeah.
What made me financially independent is not those products. What made me financially independent is investing into products that I can't get to that are illiquid, right? It's my 401k that continues to grow and I don't mess around with it. It's my real estate that I continue to pay down. And, every year I'm paying down big chunks now. My debt's going down, down, down. The value is going up, up, up. And I'm not really paying attention to it. And then the companies that I was involved with, I'm growing while I'm like nose down and just focused on growing these things. It is not QYLD or Yield Max products. Those are not going to give you the results that you want long term. I know people like to talk about them a lot, but they're kind of gimmicky and they're very expensive. And I hate fees too. So fees can really rob you of a lot of the wealth that you deserve to have in the future because you're paying 1% right now to somebody. And don't forget about it. You worked hard to make that money. You paid your taxes. Now you get some money, and then you put it into something that's highly fee-based. It doesn't make any sense, right? Just put it into something that's very tax efficient, charges you 3 basis points or something like that, something very low, and you can be much more successful, in my opinion. That's what history has shown.
Yeah. So with that being said, what are some of your favorite ETFs and stocks that you're investing in right now or that you've held for many, many years?
I have some large positions in some of the, Mag 7 type stocks, the Apple, Microsoft, Alphabet are probably my 3 largest holdings that are individual stocks. But I have been moving slowly towards more broad-based not mutual funds, ETFs. So in that space, a lot of it is the S&P 500, very simple. I own SCHD like a lot of people do. I have VGT, which is also from Vanguard that focuses on tech. I've done some different videos on combinations of different stocks. For example, a combination of XLK, which is technology, XLV, which is healthcare, and SCHD because it doesn't have a lot of overlap, and I think it offers a lot of it offers nice growth versus the S&P 500 while trimming out some of the fat that sometimes you'll find in the S&P 500. So that's kind of my setup. I continue to buy some of these. I have probably way too much overlap if you look at it all together, but I also review a lot of products and have a lot of these in there. So I've done a review before. You can find that video of like what are my top 20, and you'll see a mix, probably 10 individual stocks with 10 individual or 10 ETFs that I own. So you can always look that up too and kind of see where I'm at. But slowly as I get older, I'm selling out of the individual stocks and I'm going with more broad-based ETFs. I think, I'm not a financial analyst, and so picking individual stocks, you really want to understand what you're getting into if you're going that route. And so I'm plenty diverse. I've got lots and lots of stuff, probably way too much. And people are like, why do you have so much? But it doesn't really hurt me because of where I sit. So I don't jump in and out of products, but I just continue to buy things that I think are attractive.
Yeah, it's I think investing into individual stocks can be fun, especially if you're a nerd like I am and love to just kind of scour different ETFs and different indexes and find really high quality businesses. But at the same time, some of these companies are really convoluted and hard to understand. And so I personally just try to invest into a little bit more simple businesses where you understand what their business model is and you can, kind of comb through the financial reports. But I mean, I also don't try to invest into anything that I don't understand. So I think that's super important too. If you want to go the individual stock route where you have a portfolio of 20 to, 50 different stocks, it does take a lot of time and a lot of research. And that's what some people prefer. They like that, like myself. But, others would rather just stick with a few different sector ETFs or broad market ETFs. And I think that's a great route to go as well. What are your current thoughts on the market right now? We're going into an election year. We're going to see who's the next president within the next month. Plus, we've also seen really high gains this year as well. I think the market's up like 22%. So do you think we're going into a crash, or will it just kind of keep growing, keep going up?
I don't think it's going to crash. I learned a lesson back in the beginning of 2023. I think when everybody became quite bearish, and I kind of went along with that theme, and it never came to fruition. We just kept going higher. At that point, I did move some money to cash, and having a background in options, to me, it made sense. Hey, okay, everybody here is negative on the market right now. I'm going to move into cash with a significant portion of my money that's in taxable accounts. So this is after tax money. And I'm going to sell puts. So it worked out all right? Because I'm collecting about 5% in cash and I'm selling puts, maybe collecting another 5 or 6%. And my mentality is if I can get to that 10 to 12%, then I'm doing quite well. So it was okay, but it still underperformed the market back then. So lesson learned. So I've set my whole, account up to be auto investing every week. And my view going forward right now, as we lower interest rates, and my background's in automotive. All right. That's what my business is focused on. So we supply automotive parts, and I'm seeing a slowdown right now with the Hondas and the Toyotas of the world. And when we see this based on the last 25 years of my career being in that area, I think it's a pretty good predictor of what's going to happen. However, as we lower interest rates and we bring things down in line, I also see for the first time in the last 5 years, us actually turning people away that are looking for jobs. So we have everybody that we need in order to supply the parts that we need to supply. And that hasn't been that way for 5 years. So balancing all this out, I think as we lower interest rates, people that are sitting on the sidelines right now, recent graduates that are looking for that next car that can't afford a 7% interest rate on that vehicle are now looking at something 6, and they're going to start offering incentives. It's going to get down to 5 and then 4 and 3, and they'll pull the trigger. So I think we've got this pretty much right. I'm hoping for a soft landing. And in that case, then I think we can continue to go higher. Maybe we grind sideways for a little while, and then we go higher. but I definitely would not think that it's a good time to keep money on the sidelines, because you're not making 5% anymore. You're making 4.5%. So we have all this money on the sidelines, and I think that's going to start getting forced back into the market. Now, where you put it, I think is probably the more interesting part, right? We've seen kind of, as interest rates come down, it makes money more attractive for the small cap and the mid cap companies, because everything that they have is probably floating rate, especially for small cap. So like, we're a small company, so we see that. We get the effects of interest rates declining, our payments go down, which gives us more capital to go do things with, right? So long story short, I think that we can continue to go higher. And I think like where you put your money is going to be interesting, because we see like, are you familiar with RSP, which is the equal weight S&P 500 ETF? That's VOO, or the S&P 500, but equal weight instead of market rate. And you'll start seeing outperformance, I think, with some of those equal weight products as other companies start to join the fray here. So if you start looking at small cap and mid cap, I think that's going to be an interesting place to kind of play as we move forward. And that's probably where I'll probably put more of my money going forward, is into some of these types of products, because that's usually what leads us out of a recession that we never had, but we kind of had maybe.
Yeah, it's
so keep buying.
It's an interesting dynamic, because it seems to be, whenever the market goes up 30 or 40%, there's typically a pullback after a couple months of 10 or 20%. And we can totally see that going into the next couple months. Like, it's something that's totally, plausible. But at the same time, interest rates are going down, and they're continuing to go down throughout the rest of the year and into 2025, which, like you said, kind of takes people out of their cash accounts and puts it into the market instead, just because those rates are a little bit lower. So I think it's kind of an interesting dynamic. And yeah, the at the end of the day, it's like the best thing you can do is just keep consistently investing every single month, and no matter what happens, after a few years, you're going to come out on top. So at this point in your own investing career, do you have any specific financial goals that you'd like to hit? Any specific number within the next 5 years, 10 years, or 20 years?
Not really. I started this channel a couple years ago, and I would say I don't talk much about financial independence, but I am financially independent. I was able to save up enough and do things in the right order to kind of grow my wealth. And so now it's just kind of figuring out, where do I go from here? Do I want I don't have a specific target, but I come from a middle-class background where, this much money is enough, and I've already got that plus some. So the rest is like, let's go enjoy it while we can, because my wife and our kids we're about ready to be empty nesters in a year. So let's go enjoy life. But I'm not a FIRE type person, financially independent, retire early. I'm more of a just straight up financial independence and be able to go do more things that I enjoy. I don't think I could retire and just play golf all day. So my retirement would have to be still working, doing or something. Helping. Yeah. So I serve on the board of a few different companies. These are the types of things that I like to be involved in now. And my YouTube channel it's not lucrative. It's not something that I do for the money. It's more for just the connections and meeting people and trying to decide what I will do next. But I don't know what your perspective is, but meeting people such as yourself, people that develop these ETFs, financial advisors, that's been the best part of doing YouTube. Totally. The few bucks I make off of it, it doesn't change what I do. But the connections and, finding like-minded people has been kind of the thrill for me. So I'll probably just continue to grind forward. When it comes to financial planning, for a 52-year-old going forward, I look at what can I do for my kids to make their life easier, but I don't want to give them anything beyond that, because I think the thrill of it is going through all of that and growing your net worth yourself and kind of learning that as you go along. So we'll see where we go. But
yeah, there really is something powerful about learning your own lessons. When I first started in the market, I was super ignorant. Like the only thing I knew about stocks was that it was a piece of a company, and I just kind of just threw money everywhere. And as you can imagine, I lost a lot. And I was really young. I was only 20 or 21.
Okay.
And but I'm super grateful for those lessons because long term, those lessons are just kind of a blip, right? And they can teach you to be really wealthy long term. So that actually leads me to my last question, which is if someone came to you, whether it be a friend or one of your kids, and said, "Hey, Dave, how do I build wealth in the stock market? How can I eventually become financially independent like you are now?"
Yeah. First of all, getting started at 20, that's amazing. I wouldn't have known what a stock was at age 20. So now that we have YouTube, now that we have all this information out there, it makes it so much better for young people to get involved really early and have that extra time to grow that wealth. So I think that's going to be a real big game changer for people to get started early. But if somebody was to come to me and say, "How did you do it?" I would say the most important thing is, again, going back to that scared kid that graduated from college, is that you have that order of operations set properly. So the very first thing you need to do is to pay yourself first. That's my way of saying it. You'll find it in all kinds of financial books. Somebody will say exercise your savings muscle. Somebody else might say wealth is what you don't spend. I say pay yourself first. That means before you do anything else, grandma gives you $100. You take $25 and you put it in there for your future self so you can grow a big nest egg for retirement. Then you decide on what you're going to do. How much apartment can I afford? What kind of food am I going to eat? And when am I going to go on that next vacation? If you do that, then you're going to become financially independent. I mean, you have to work through some calculators and things like that. People don't like to hear that because they're going to have all the excuses of why they can't have that order. But if that's your order, you will have success. So, if I was going to tell my kid, that's exactly what I would tell him. Get started. Now, as far as what products to buy, VOO or VTI or any of these are a great way to get started. I think it's great to have an international fund. I mean, we've seen what China did over the last couple of weeks. If you've been following that, it's exploded. So I think being diverse beyond the United States is a smart thing to do at this point. But yeah, I would really just make sure that you start savings and start exercising that savings muscle so that you can grow your nest egg and you'll be off to the races.
That's great. I love it. Having the order of operations and flexing that investing muscle. I love it. Well, Dave, thanks so much for jumping on today. Those of you who are listening, go check out Dave's channel. He's got a lot of just really helpful, insightful, educational content on his channel. You're guaranteed to learn something if you check out his stuff.
Great. And thank you. And I appreciate you sticking your neck out and doing these types of things. And those are the kind of actions that you take that are going to take you to the promised land anyway. So you're killing it. Keep it up.
Of course. Thank you. See you, everyone.